It started as an ordinary Wednesday morning until the blockchain blinked. In seconds, the number 300 trillion appeared on Ethereum's public ledger. Not in some obscure test network, but tied to PayPal's official stablecoin, PYUSD. What followed was one of the most baffling technical events in crypto history, a 300 trillion minting error. For about 20 minutes, the world's financial system was staring at a ledger claiming PayPal had created more money than ever existed. Blockchain analysts first spotted it on Etherscan, noticing an unprecedented surge in PYUSD's total supply. Paxos' wallet had minted hundreds of trillions of tokens, a figure so absurd some thought it was a bug. But it wasn't a bug. The tokens were real, cryptographically created. This minting event was time-stamped and visible on-chain, sparking immediate chatter across social media. Within minutes, crypto analytics dashboards lit up, and Telegram groups flooded with screenshots. PYUSD supply plus 300,000, one bot alert read, met with stunned reactions. Bloomberg confirmed it wasn't hacking, but an internal glitch during a system transfer by Paxos engineers. Paxos explained it was a routine operation gone wrong, where an internal script processed an incorrect value. In layman's terms, they accidentally issued new tokens instead of moving existing ones. Engineers noticed the discrepancy and halted the process within minutes, reassuring users that no funds were impacted. The extra tokens were quickly burned, restoring the correct supply. The entire event lasted roughly 20 to 30 minutes, less than half an hour. But in crypto, 30 minutes can feel like an eternity. Automated trading bots and DeFi platforms reacted instantly to the anomaly. Some decentralized exchanges paused PYUSD trading, while others interpreted the spike as a possible airdrop. All of this happened in real time, visible to everyone. It was a rare glimpse of how transparent and unforgiving blockchain can be when code misfires. Paxos, founded in 2012, is a regulated blockchain firm issuing digital assets backed by real-world reserves. They're trusted by giants like PayPal and MasterCard, making this incident even more shocking. PayPal's entry into stablecoins was seen as a milestone for crypto adoption, so this glitch shook confidence. PayPal executives were notified immediately, pausing API-based PYUSD transfers to verify user balances. They issued a statement, emphasizing that no accounts were impacted and they were working closely with Paxos. Regulators weren't going to let this slide quietly. They requested a formal incident report from Paxos. Investigators wanted to know how such a massive mint command could execute at all, even for a few minutes. Despite the eye-popping number, markets remained calm. Bitcoin and Ethereum barely moved. Traders realized this wasn't a liquidity event. It was a data event, highlighting the fragility of digital infrastructure. Even with audits and regulations, a single coding misstep can generate an amount of money that defies reality. This wasn't the first time something like this happened. Tether had a similar incident in 2019. But this case involved a regulated corporate-backed stablecoin tied to a major fintech firm. Experts said the glitch highlights that automation in finance must include human oversight. Public transparency is both a blessing and a curse. Errors unfold on a global stage in real time. Within 24 hours, Paxos conducted an internal audit and reached out to regulators with full documentation. They took full responsibility for the operational error and implemented additional safeguards. By the end of the week, the $300 trillion event became a viral case study across tech and finance media. It served as a wake-up call that stablecoins are only as reliable as the code behind them. When Paxos engineers finally deleted those 300 trillion in phantom tokens, one thing became clear. The glitch may have been fixed, but the shockwaves were just beginning. Across Wall Street, Washington, and the crypto world, the conversation shifted from what happened to how it was even possible. The Paxos incident triggered what regulators called a structural stress test for stablecoins. In an industry fighting for legitimacy, this showed how a single miscalculated transaction could rewrite global money supply, even if just for 20 minutes. Within hours, Paxos released a technical statement on X, explaining the minting error stemmed from a faulty internal automation script. The code misread a token issuance parameter, multiplying the mint amount exponentially. Paxos's engineers quickly isolated the issue, halted minting, and initiated a rollback to burn the excess tokens. They verified that the off-chain ledger tracking customer funds had never changed. A Paxos spokesperson clarified, "This was not a security breach nor a compromise of funds." By the end of the day, both Bloomberg and CoinDesk confirmed the Ethereum blockchain reflected the correct supply, returning PYUSD's total circulation to about 2.6 billion. But the visual of $300 trillion minted was burned into the crypto community's memory. At PayPal, the incident triggered an immediate risk review. They temporarily suspended direct PYUSD transfers while running forensic checks on customer balances. A spokesperson assured that no PayPal customer balances were affected, and they were working closely with Paxos. Internally, PayPal initiated a full audit of its blockchain integration with Paxos, with oversight from cybersecurity firm Trail of Bits. The reputational stakes were enormous. PYUSD is PayPal's public face in crypto. The regulators moved fast, with the NYDFS requesting a detailed incident report. They wanted to know which safeguards failed and if human approval was needed for large-scale token issuances. The U.S. Treasury's FSOC flagged the event as a material test of stablecoin operational resilience. Concerns about automation bias in blockchain finance were raised, urging issuers to adopt dual authorization governance for mint and burn transactions. By October 23rd, the NYDFS confirmed Paxos submitted a corrective plan, including a multi-signature approval process for any mint over 10 million. Real-time reconciliation between off-chain ledgers and blockchain issuances was also part of the plan. These measures would serve as the new industry baseline for compliant stablecoin operations. Financial analysts described the Paxos event as a harmless catastrophe. No funds were lost, but confidence was tested, and that matters in a system built on trust. The glitch was a human error amplified by perfect transparency. Everyone could see the minting happen in real time. This shows that transparency doesn't eliminate mistakes. It just means everyone sees them at once. Despite the massive number, the market impact was minimal. Ethereum gas fees spiked briefly, but Bitcoin and Ether prices stayed stable. DeFi platforms reacted cautiously, restricting large PYUSD deposits until Paxos confirmed the burn. The markets stabilized almost instantly, but the debate about reliability had just begun. Stablecoins now facilitate over 150 billion in daily crypto transactions, connecting traditional banking with blockchain ecosystems. When a regulated issuer like Paxos accidentally mints more value than the entire planet's GDP, it raises questions about governance and trust. The Paxos event is what happens when Wall Street systems meet Silicon Valley code, and both assume the other won't fail. Within 2 weeks, the incident began reshaping policy, with lawmakers reviving the Stablecoin Regulation and Reserve Transparency Act. The European Central Bank added stablecoin issuance controls to its agenda, citing Paxos as a learning moment. Even in Asia, Singapore's Monetary Authority began reviewing local stablecoin code validation protocols. For all its drama, the Paxos glitch may end up remembered as a pivotal turning point. The transparency of blockchain meant the issue was instantly visible and verifiable, correcting itself without financial loss. Paxos emerged with credibility dented but intact, and regulators gained a case study for stronger guardrails. Experts expect major stablecoin issuers to follow Paxos's lead in implementing multi-signature minting controls. Ultimately, the Paxos glitch revealed a fundamental tension in the future of finance. Do we prioritize speed and automation, trusting machines to execute monetary logic flawlessly? Or do we insist on redundancy and oversight, knowing that human fallibility is still part of advanced systems? The $300 trillion glitch wasn't just about crypto. It was about the fragility of automation in interconnected systems. For the industry, it's a humbling moment, and perhaps a necessary one. As stablecoins dive deeper into global finance, we face a crucial question. It's not about if another glitch will occur, but whether we're prepared for it. We're FinXNet, and today, we explored the $300 trillion crypto glitch. If you found our analysis insightful, don't forget to like and subscribe. Turn on notifications so you won't miss our next deep dive. Together, let's navigate the future of global finance and technology. Till next time.